This market opener breakout trading strategy has a win ratio close to 90% on the 5-minute chart. With this strategy, you will never have any doubts about whether or not to take a trade. It has clear rules in place that ensure you only take high-probability trades when the market opens. Check out these signals given by the algorithm on the Ethereum price chart. Using this method of trading, it is possible to detect perfect trade entries in a trending market and to cancel all false signals during periods of consolidation. And the best part is, you do not need to look for trading signals throughout the day. All you need to do is scan different trading instruments at the market open for 10 minutes a day and execute high-winning trades. In this short video tutorial, I will explain this trading strategy from A to Z so that you can make the same profits from trading. Dear viewers, if you enjoy my content, please like this video and subscribe to Magic Indicator Strategies if you haven't done so yet. On this channel, I share the most advanced trading strategies explained in the simplest way possible so that even a beginner can learn them. Before I show you how to add these indicators to the chart, I want you to understand why this trading strategy is so effective. As the name suggests, this trading strategy uses an indicator that spots price breakouts at market open. The opening of a trading session tends to be characterized by high volatility due to overnight news, announcements, and traders' reactions to developments. Traders leveraging market open strategies look to exploit this volatility. High volume during the market open indicates strong interest and potentially strong price movement. After initial volatility in the first few minutes, stocks may start to trend in a particular direction. This is when retail traders look for breakout levels to initiate trades. This indicator was created with a specific purpose, to make it easier for traders to analyze price action in the first few minutes after the market opens. The main market opener breakout indicator has multiple components. The first component is the colored background, which represents a particular trading session. New York trading session is enabled by default, but you can choose whatever session you wish. The second and third components are lines and signals. To understand how a buy or sell signal is produced, we need to look closer at the very first candlestick that forms within a trading session. That candlestick basically sets the trend for the whole session. For example, here is the first candle bar that opened the trading session. The indicator highlights two price ranges. The candlesticks range between high and low, and the average true range of the last 14 candlesticks. When price breaks below the candlestick's range, the first breakout occurs. It is marked by a red triangle. This signal suggests that the market might move to the downside in the near future, forming a downtrend. You should be prepared to sell the security when this signal occurs. When the price breaks below the average true range, a red diamond appears on the chart signaling a stronger breakout. This suggests that the price is likely to continue to fall in the near future. On the other hand, when price breaks above the market open candlestick range, the indicator prints a green triangle. This suggests that the future trend is likely to be bullish throughout the whole session. When an ATR breakout happens, the indicator prints a green diamond. There may also be a scenario where the range gets broken again, but in the opposite direction. What should you do in this case? How do you filter out fake breakouts? The simplest way to do that is to add an exponential moving average to the chart. There is no need to overcomplicate things. A regular EMA with a length set to 100 does a great job at eliminating fake signals. Our goal is not to use it in a standard way, in which we buy when the price is above it and sell when it's below it. A far better option would be to enter the trade at a pullback to the EMA. With this approach, you are able to enter the trade at an average price, avoiding overbought and oversold markets. With that being said, let me show you the exact rules for opening long and short trades. But before we proceed, if you're tired of losing trades and looking for proven indicators with a high win ratio, look no further than EasyAlgo. They offer the two most advanced technical analysis tools that will make you a market expert. In addition, you will get access to a private Discord community where you can chat, get support, copy other traders' signals, and learn trading skills 10 times faster. Hundreds of traders make consistent profits with EasyAlgo. You can be one of them. Click the first link in the description and secure your spot today. Let's return to our trading strategy. The conditions for a buy trade look as follows. Pay close attention to what I'm about to teach and watch the video again if necessary. A long trade is opened at the start of the session if A, there is a bullish breakout in the price. B, prior to the breakout, the price pulls back to the 100 EMA. It is best to open the trade at the first breakout or the green triangle. This way you'll get a cheaper price. Set the stop loss at the recent swing low. Target twice the risk with an adjustment of the stop loss to the break, even as soon as price reaches half the target. You can also set a trailing stop loss at the distance of your initial stop loss. This money management will allow you to make maximum profit from the ongoing trend. In the following example, the price broke above the EMA and retraced back to it. This happened before the market open. We can consider this as a valid pullback. The price is at its 100 candlesticks average. In order to initiate a long trade, we wait for the market to open. If a bullish breakout occurs, we anticipate the price will continue to move upwards. We follow the strategy's rules and open a long position. Let's see how this trade plays out. A short trade is opened at the start of the trading session as well. Make sure the following requirements are met. First, the price breaks below the candlestick's range. When this happens, a red triangle will be printed. Second, prior to the breakout, there must be a price retracement to the EMA. Set the stop loss at the recent swing high and target 2 times the risk. Apply the same money management as for long trades. In the next example, we see the market is trending downwards. The price found resistance at the 100 EMA. As soon as the session opened, there was a breakout of the candlestick's range to the downside. A sell signal was produced. This trading strategy is fairly simple so that even a beginner can use it. It requires only 2 free TradingView indicators. Let me show you how to build this setup step by step. First, open the indicators and search for a tool called the Main Market Opener Breakout by Hassan Rifat. Apply the indicator to the chart. There is no need to adjust any settings, however you can switch sessions to find the one with the highest accuracy. For the second indicator, install the moving average exponential. Open its inputs and change the length to 100. Backtest and forward test this trading strategy on different assets and time frames. If you have any questions, feel free to ask in the comments. Thanks for watching. Till next time.